Welcome to the Chorus One podcast. In this podcast, we explore the emerging open financial system facilitated by scalable, interoperable blockchain networks. Tune in every Monday to dive deep into cutting-edge projects and protocols with Chorus One team members and guests.
Hey, today we are chatting with Nicholas Platias from Terra. He's the research head at Terra. As you know, Terra is a stablecoin network that produces stablecoins pegged to a few different units of account like Korean won, US dollars, SDR, etc. We'll be covering a lot of topics related to its stability mechanism and how the internals of Terra work. Nicholas, welcome to the show.
Thank you. Thanks for hosting.
So maybe before we start, it would be nice to have a quick background about you and how you got to be involved with Terra.
Absolutely. So I come from Greece originally, and I am very good friends with Do, who's one of the two founders. So we went to college together in the US. We were basically roommates, and we went on briefly divergent paths. After we graduated from college, we both started companies. And then I think we both developed an interest in cryptocurrencies that became more, I'd say, pronounced roughly in 2017 when stablecoins became more popular and they were discussed. So there were several projects, so MakerDAO, Basis. And so I developed an interest in stablecoins, and at the same time, I think Do was thinking about similar problems. And we discussed working on something together. Do had already teamed up with Daniel, who founded Timon, one of the largest e-commerce companies here in Korea. And I think part of his vision was how to make commerce more efficient and also utilize blockchain in a way that actually has real-world usage, real-world value. Because cryptocurrencies, even until now, are basically used for trading. So they're highly speculative and very little utility value to them. And I think that was part of the vision. And yeah, it seemed like a very exciting opportunity for me. I flew over and I really love it here. Korea is a very interesting place. Very fun, especially when you're young.
So you are actually living in Korea now?
Absolutely. I moved here a bit more than a year ago.
That's really cool. And so you're heading research at Terra. So what do you personally focus on and what is your day like?
So I think the great thing about research is it's a very fun, very diverse. The role has a lot of diversity. So for me, I love it because I basically just get to solve fun problems. So it's pretty much a problem-solving job that has to deal with lots of different systems and mechanisms across the board in terms of what Terra faces. So you can think about a stack where we have the blockchain at the very base. So questions such as which blockchain do we build on? What is our architecture? Why do we choose this one versus the other? And which platform basically would support our vision best? And this involves questions, for example, also such as oracles. So there are many other pieces on the blockchain level which are necessary for our design to work. Then on a slightly higher level, you have the economics of our design. So main focus would be stability. So how do you design a stable currency? How do you define the peg? What assets do you choose to peg against? And then we have the Terra and Luna stability mechanism design. We have a decentralized exchange, which is the swap mechanism between Terra, Luna, and the remaining family of currencies. So that's a market design problem, which also falls within this umbrella of economics for the protocol. And there's tons of other questions within that realm that are very interesting. And one layer above that is the DApp layer. So essentially looking at Terra as an ecosystem, what can be built on top of our platform. So starting, for example, with payments. So a decentralized payment network is the first main application that we're building. And there's lots of interesting questions to think about there. So an example is how do we most efficiently allocate seigniorage for the economy to grow? And in our case, this involves giving discounts. So how do you do that? How do you budget discounts in a sustainable way in order to make sure that the economy grows sustainably, but at the same time, you don't overextend yourself? And this generalizes to questions about the treasury. So it's the treasury from which seigniorage is deposited that would then fund discount programs. But of course, you can have multiple other budget programs from different DApps. And so how you design this and also how you allocate seigniorage to each budget program is also another question that would fall under that umbrella. So it's very diverse, and it's basically problem solving across the stack, which I really enjoy. And I think we've put together a highly intelligent and very strong team that enjoys what we do. And I think that's the most important, actually. To have fun and solve problems that you like. I think then the rest usually follows.
That's actually already a great bird's eye view, right? So there's like this blockchain layer, what blockchain to use, etc. There's the stability mechanism. How do you keep these things stable? There's, of course, the question of what to peg against.
Mm-hmm.
And then there's essentially like this application layer, what application to use your stablecoin for, in this case, payments, and how to use it effectively.
Yep.
And finally, there is the market design problem of how do you allow the conversion between, in your case, Luna and these Terra currencies and things like that.
Mm-hmm.
So, of course, we can't talk about all of these things in a video. So in this video, our focus is going to be around like the stability mechanism and maybe a little bit around the market design. And we leave the questions of how to allocate seigniorage well, what blockchain Terra is using and why, and what currencies it's pegging against and why, to a later video.
Sounds good.
Just as background for our listeners, what is the current state of the Terra network like, and are there any stable coins live today?
Yeah, so it's very exciting times. We launched our Columbus mainnet a few weeks ago, and things went extremely well. We have, I believe, hundreds of thousands of blocks already mined, and so everything is ready for our payment network launch, which will be done in the next few weeks. And the rationale here was we wanted to make sure that shortly after our blockchain launch, we would have actual usage. And we're very excited to see significant transaction volumes to flow through. Yeah, so we have a large e-commerce alliance that is already lined up. We'll be launching with Timon, who's our first e-commerce partner, very soon. And I think that it's exciting to see that we're one of the very few blockchain projects that is about to get significant real world traction. And hopefully other projects can follow in making sure that the designs and the reason for cryptocurrency to exist actually comes down to being useful and used.
You already have some stable coins live, and in this e-commerce integration, people are going to use these stable coins to make payments to these e-commerce players.
Mm-hmm.
That's really interesting. Let's get into the question of how these stable coins work, right? So to start off with, my understanding is that the most important stable coin is going to be the Terra SDR. Is that right?
Yes. So we picked the Terra SDR. The rationale behind that was that as the SDR is a global currency basket that is largely representative of the global economy and doesn't over-index in any single economy, and also tends to be least volatile relative to any individual local currency. So Evan actually from our research team, wrote a great post where he provided a great in-depth analysis as to why the SDR is a good option.
So you have this Terra SDR, and then there's a different coin in your ecosystem, which is like the Luna.
Mm-hmm.
And for the stability mechanism, perhaps we can focus on the interplay between Luna and the Terra SDR and how the combination of the two keeps Terra SDR stable.
Absolutely. So I think the first thing to touch upon is the idea that we want to keep the price of Terra stable. And so because demand may fluctuate, we adjust supply to make sure that the price remains at the peg rate. So if demand for Terra goes up, then you may need to issue more Terra to bring the price down. And conversely, if demand goes down, then you would need to buy some of that back. So that's the sort of macroeconomic way of looking at currency and stability. I think the more micro perspective, which really is the opposite side of the same coin, is looking at the protocol as a market maker that buys and sells Terra very close to the peg. So what that would mean is, for example, the protocol might be buying Terra at 0.99 SDR and selling it at 1.01 SDR. And effectively what that means is if the price of Terra were to drop below 0.99 SDR, then there would be an opportunity to trade it in with the protocol. And that would contract the supply of Terra. And conversely, if the price were to go above, the opposite would happen. And essentially this market-making mechanism is the microeconomic way of implementing this idea of expansion and contraction. That's where Luna comes in. So we have a decentralized market where this market-making operation for buying and selling Terra on behalf of the protocol happens via Luna. And the basic idea there is Luna plays two roles. So the first role is it is the proof of stake token for our network. So essentially, validators will buy and stake Luna in order to participate in consensus. So in that sense, Luna is very key for the security of the network. So you want to make sure that at least 2/3 of staked Luna is controlled by honest nodes in order to make sure, based on the Byzantine fault tolerance that is guaranteed by Tendermint, which is the underlying blockchain, to make sure that consensus works correctly. So that's one aspect. And the second aspect is the fact that because Luna is the medium for this market-making mechanism, so essentially you either buy Terra by issuing Luna, or conversely, you sell Terra by buying back Luna. Essentially what this creates is a system where uncertainty in the price or the demand for Terra translates to uncertainty into the supply of Luna. So essentially the volatility that comes with Terra demand ends up with Luna. So Luna essentially absorbs this uncertainty, and in that sense, it is also key to the stability of the system beyond its security.
That makes a lot of sense. I think like 3 years back or something like that, I interviewed Robert Sams, who wrote this paper on seigniorage shares.
Mm-hmm.
And to me, Terra looks like the first system that does something similar to seigniorage shares. And I think your description is really great, right? Like, this is really a market maker. So effectively, this is a market maker that is willing to buy and sell Terra at a certain price, and whenever like the price of Terra SDR fluctuates from one SDR, I can go to the market maker and buy and sell with the market maker. I mean, let's consider this scenario, right? So the first scenario is, of course, the scenario where things are going well. So I'm a holder of Terra SDR, and Terra SDR is trading right now, let's say for convenience sake, at 1.10 SDR, right? So it's actually broken its peg on the upside. And at this point, I have Terra SDR, but they are more valuable than the SDR. And so how would the market maker work in this scenario? And what kind of opportunity does it allow traders to use?
Right. So we've assumed that Terra trades at a 10% premium relative to the peg rate.
Yeah.
Right. So basically, the idea there is you create an arbitrage opportunity because the protocol is willing to buy Terra just below the peg and sell Terra above the peg. So basically what would happen is, in this case, an arbitrageur would be able to buy Terra much cheaper from the protocol and then sell it to the market for a profit. And essentially that would be possible until the market price comes down all the way to the peg. So this is a way of expanding supply. And the other way of looking at it is the market maker simply brings the market back to the peg.
So effectively, if I'm holding Luna in this case, then I can go to the Terra protocol, this protocol market maker, and give it like 1 SDR worth of Luna and get 1 Terra SDR. Now the Terra SDR that I got 1 Terra SDR, but in the market, let's say on Coinbase or someplace, I can sell this 1 Terra SDR to get 1.10 SDRs. So that's why I can make a profit.
Exactly.
So what has happened is I, as an arbitrageur, can make this profit. But on the other side, what has happened for the protocol is an arbitrageur like me has come in, given up Luna and got Terra SDR. So the protocol has managed to like create new Terra SDR, and it has managed to like sort of own part of the Luna supply. Is that right?
Yep.
So effectively, like the Luna supply has shrunk, and the protocol has been able to create this new SDR, and this is how Terra SDR flows into the economy.
Exactly. So that's where the notion of seigniorage comes into play, right? So essentially, as you said, via this process, the protocol mints new Terra and earns equivalent value of Luna in return, right? And traditionally, when you think about currency, the ability to issue currency has been usually the prerogative of governments. And it's been massive power throughout history because essentially the profit from minting currency is what is considered seigniorage, right? So back in the day, for example, if you had a gold coin which contained, let's say, 0.5 gram of gold, then you have a cost of minting it, which is that amount of gold. And then if the face value of that currency is higher than that, then the difference is what you would call seigniorage. And in our case, the way that we receive that is in the form of Luna. So the protocol earns this amount of Luna when Terra is issued, and then it is up to the protocol to determine what the most efficient use of that earned Luna is.
I guess like seigniorage is really a superpower, right? So like, for example, if you look at the United States, the US dollar is used for so many international activities and as reserved by so many nations. But at the same time, the Federal Reserve is able to create US dollars and expand the monetary base of US dollars. Now, when the Federal Reserve creates US dollars, it can put those new US dollars to use for beneficial purposes inside the US economy.
Mm-hmm.
So that's like a superpower, right? You can like just create this money. You don't need to tax the citizens in your nation. You can just create money, use it for beneficial purposes. And, like this is another source of spending power for a central bank or a government, right? And now Bitcoin was the idea that you can use seigniorage, the creation of new Bitcoin, to power a network of computers that is going to manage a ledger.
Mm-hmm.
So that is mining. So in Bitcoin, you have seigniorage. New Bitcoin are created every block. And those new Bitcoin power these networks of miners. They build these huge ASIC farms. They burn a ton of electricity and they manage this ledger. And Terra's idea is you have seigniorage in Terra. And like now this protocol got this Luna because of the arbitrager. And now this protocol can use this seigniorage to actually do some beneficial things in the Terra economy.
Absolutely. So I think it's actually important to think about seigniorage less so as this magical creation that lets us print money out of nowhere, but rather in the case of Terra and in the case of a stable currency, what you earn by responding to the needs of the market, right? So essentially, the protocol guarantees that new Terra will be issued strictly when demand for it increases. And then it has the fortunate problem to solve, which is what do I do with this created value, right? Which comes in the form of Luna. And then it needs to decide, well, what is the best way to use it? Do I want to fund budget programs that will help the economy grow? Or do I want to reward validators or miners for their contribution to the network by burning a portion of it, right? And I think we can touch upon this later. I think that's the crux of what makes our stability mechanism interesting. So basically balancing between the twin goals of our protocol. So we have stability on the one end. So we guarantee that Terra will remain stable at its peg. And we also have adoption as a core goal that is enshrined at the protocol level. And that is one of our core philosophies and why we think that Terra can become successful, right? So making sure that it adds real value in it, that it's competitive and in fact, in many ways superior to fiat currency, right? And that's where the question of senior distribution comes. So we have a certain amount of seniors that we've earned, and we need to answer how much of this will be allocated towards stability, which in practical terms means rewarding Luna holders or rewarding validators for their services in the network and for creating demand for Luna. And that will mean burning that portion of Luna. And how much will go towards funding adoption? So we have the treasury, which essentially is a collection of funds that is collected through seigniorage and then is allocated towards budget programs based on an algorithm which determines the efficiency of each funding program. And the decision between how you allocate seigniorage between those two is optimally allocate between the two, I think is very powerful.
Yeah, I guess like the long-term success or failure of the system depends on how well it makes these allocation decisions. And we can return to this topic later. But the other side is also very interesting, right? So the other side is when Terra SDR is trading on Coinbase Pro at 0.90 SDR, right? So this is the other side of the coin. Where it's broken the peg, where Terra SDR has broken the peg, but it has broken the peg on the downside, right?
Mm-hmm.
So how does the protocol that is the market maker act in this scenario?
Right, so it's the exact opposite. In that case, the protocol will be buying Terra SDR in the form of Luna for, let's say, roughly 0.99 SDR. So if Terra SDR is trading at anything below that, so let's say that it's trading at 0.9 SDR, then an arbitrageur can buy Terra SDR on the market for 0.9 SDR, then swap it in for 0.99 SDR worth of Luna, and then sell that Luna for a profit. So essentially this bridges the gap between the market price and the price that the protocol offers and is the flip side of expansion. So supply would contract until the arbitrage disappears, essentially.
So Terra SDR has gone out of the supply. More Luna has come into supply because the protocol has given out Luna. And so the arbitrager has made money. But because more Luna has come into supply, any holder of Luna or any validator of Luna is essentially stand to lose in this scenario.
Right. So this is indeed a downside risk that the validator or the Luna holder faces. And in that sense, it's why we consider Luna key to the stability of the system, right? So it is a priority of the protocol to make sure that demand for Luna remains stable and is increasing over time, despite fluctuations in the demand for Terra or its price, right? So there will be situations, as you described, where to maintain Terra at its peg, new Luna would need to be issued. This presents downside for Luna holders. And the protocol wants to guarantee that this does not affect demand for Luna. So even when Luna is being diluted, because more Luna needs to be issued, Luna holders are properly compensated to make sure that demand is not affected. And so if more Luna needs to be issued to buy back Terra, then the protocol will be able to do it in a sustainable way.
So if I think as a Luna holder, right, like, so of course with any asset, like holding any asset, there is like risk and there's reward. There's potential downside and potential upside. The potential downside to me is very clear. It is that when Terra SDR falls, I'm going to get diluted. Enshrined, very clear to me. As a Luna holder, what is my upside? What is sort of the fundamental value of a Luna that should entice me to hold Luna?
Right. Well, my hope is that for most validators and for the market, the upside is more obvious than the downside. So the upside is very clear. Right? The rewards that you receive as a validator or a delegator for contributing to the security of the network, right? So those rewards come in the form of transaction fees. Essentially, for every Terra transaction, let's say that I send you one Terra, and let's say that there is a 0.1% transaction fee, then that amount would be paid out to Luna validators for their service. And so in that sense, you can look at Luna as a token that lets you participate in the growth of the ecosystem. So if the Terra economy grows, if transaction volume increases and usage increases, then that means that the fees that will be paid out as rewards to miners or validators would also increase. So in that sense, you participate in the upside of the network. And if you believe in the vision, if you believe that Terra can succeed, you're rewarded a lot for the commitment that you make towards being a validator.
Okay, so I mean, like maybe it's nice to clarify something here. So on the Luna side, there's like the Luna holders, there's the Luna delegators, and there's the validators. Like these three are both exposed to the upsides and downsides of Luna, but they have like different trade-offs, right?
Yep.
I mean, if I just focus on the Luna holders for the time being, right? So like any proof of stake network, Luna holders must delegate to a validator, and the validator then ensure the security of the system.
Or run a validator for themselves.
Or run a validator for themselves. If I'm a Luna holder, right? So let's say, I don't know, I own 1% of the supply of Luna. I know that if it breaks the peg and if it goes to 0.95, I'm going to get diluted and I'm going to go down from 1% to, I don't know, 0.9%, something like that. The upside scenario for me is that this network is going to do transactions. And when there's lots of transactions on the network, there's going to be transaction fees that are collected. And then this pot of transaction fee is going to be split between me, the Luna delegator, the Luna holder / delegator, and a validator that I have delegated to. Mm-hmm. And so it's like every year I'm going to get some kind of annual dividend of transaction fees.
So I think dividend is not the accurate word because it's a reward, right? It's compensation. But yes, you can think about it as a payout in that sense.
As a payout. So every year I'm going to get this reward, which is my share of the transaction fee pool of the Luna ecosystem. Mm-hmm. And when I'm owning Luna, I am basically betting that this pool is going to grow bigger over time. Is that the right way to look at it?
Yeah, so you participate in the growth of the network. And of course, to purchase Luna and either delegate it or run your own validator, of course, you need to have belief in the future of the network and the fact that demand and volume will increase. That said, I think there is a very key part of our design which I believe makes the decision to either run your own validator or delegate with another validator very straightforward if you believe in the long-term future. And that is the fact that rewards are smoothed out over time to make sure that uncertainty in the demand for Terra, which would often result in dilution, as you mentioned, is something that does not affect me as a validator. And the idea there is the following. So what we care most is what are the rewards that I receive for a unit of Luna. So let's say that tomorrow you buy 1 Luna and you have a friend you want to delegate to. And so you start earning some rewards for that. And to your point, there's a risk that you're running, which is that demand for Terra goes down and more Luna needs to be issued. So now you have been diluted, essentially. So there's more Luna out there than when you bought your Luna. And the protocol wants to protect you from that risk. And so essentially what we look at is what are the rewards per that unit of Luna, and let's make sure, the protocol makes sure that your rewards are stable and increasing over time, regardless of changes in Luna supply. So essentially what that would mean is if, let's take a very extreme scenario just to make the point clear, let's say that the supply of Luna doubles, something that would be extremely unlikely, but to make the example clear. So the supply of Luna doubles, which now means that the rewards that you would receive for your 1 Luna would go down by 50%, right? So what the protocol would do is that it would actually double the rewards on aggregate to make sure that you're completely unaffected by that event. How does it do this? So there's 2 levers that the protocol uses to create this stable rewards schedule. So the first is transaction fees themselves. The idea being that we use a dynamic transaction fee which ranges between 0.05% and 1%. And by changing that fee, we can basically change how big the rewards would be relative to certain volume of transactions. So out of 100 Terra worth of transactions, if you double the transaction fee, then you double the rewards. And then the second piece, which touches on seigniorage that we discussed earlier, is how much of seigniorage that the system earns is burned to essentially counteract dilution, right? So the process of burning and the process of issuing Luna are essentially 2 opposite processes. So the risk that I run as a Luna holder is that demand for Terra goes down and that will be diluted. The upside is that when demand for Terra goes up, then some of that Luna that is earned will be burnt, and so will compensate me for that. And we also want this to be dynamic because we want to make sure that validators and delegators are protected from this volatility. And so we have this idea of a burn rate, which simply says, how much of new Luna do I burn? So let's say that your burn rate is 10%. Then that would mean that for every Luna that is earned as seigniorage, 0.1 of that Luna is burnt to essentially reward Luna holders for being part of the network, right? And this is also something that we can change. And by looking at transaction fees and this Luna burn rate, these are 2 levers that let us make sure that unit mining rewards, which is the mining reward that you get per unit of Luna, gradually increase over time. And the risk that we discussed, which is dilution, so let's say Luna supply doubles, so you're diluted by 50%, then by both increasing transaction fees and also by burning Luna faster whenever Luna is earned, we are able to completely shield you from that dilution. So essentially, we are able to protect you from that downside risk and at the same time let you participate in the growth of the network a long time because of your commitment, right? Either by investing in becoming a validator. So that takes quite a lot of investment and sophistication to set up correctly. So you have those costs, you have the ongoing costs of running the network. And the goal is to reward you in a way that protects you from uncertainty when you make that investment.
Okay, so if I think of a Luna holder that is running a validator, so I'm somebody that owns like 1% of the supply and I run my own validator. And that's it. Nobody else delegates to my validator, like the simple scenario, right? So in this case, what's really happening is I stand to make some sort of percentage reward return on my... So I think there's like 1 billion Luna in supply right now, right? Something like that. So If I own 1%, that's like 10 million Luna. And on this 10 million Luna, I'm going to have some percentage rewards in the end. Maybe it's 2%, maybe it's 3%. This is the transaction fees. This is my slice of the transaction fee pie, right? Like I'm going to make, I don't know, 2% of my total Luna holdings annually or something like that via this transaction fee collection. The downside is clear. So if Terra SDR goes down, I no longer own 1%, I own 0.9%. The upside materializes in two forms. So the first form of upside is if new Terra SDR is created, then part of the Luna supply will be retired. So my percentage of the network will grow from 1% to 1.1% or 1.2% if there's lots of demand for Terra SDR and lots of new users materialize. And the second form of upside is this transaction fee collection. So by owning this 1% of the supply, I might be getting, let's say, 2% reward rate or 2.5% reward rate, something like that, every year continuously as the Terra network grows. And what the Terra network tries to do is to make this level of reward that I'm making kind of stable, right? Like this, that this level of reward will not jump around very radically. It will be kind of stable. And in that sense, this resembles what some very mature companies try to do with their dividend payout. So if you look at like a mature company, like, I don't know, Nestle or something like that, it will give like a small dividend every year, maybe a 5% dividend every year. Even if the business does badly, the dividend will be there. Even if the business does well, the dividend will be there. And it will be there at that 5% rate. And that's the sort of experience you seek to create for the Terra holder, that they are going to get their slice of the transaction fee pie and it's going to be very stable.
Right. So to reiterate the point, I think the dividend analogy is not very apt in the sense that as a Nestle shareholder, I basically just buy my shares and sit there and see them grow. Versus in our case, you need to actively participate in the network. But yeah, looking at this from the rewards perspective, I think the analogy is a very good one. So you want to make sure that the uncertainty in demand for Terra and the volatility that comes with that is not something that as a Luna holder you will be exposed to. And as you said, indeed, either by making sure that a larger amount of Luna that is earned is burned, or by increasing that transaction fee, we're able to create those conditions. As a research team, we've done a lot of work in figuring out exactly how this mechanism will work and making sure that this nice story of saying, you have transaction fees, you have Luna burn rate, and all that somehow works together to create stable returns. We've put a lot of work in simulating all of the variables involved in the system and making sure that the mechanism does what it's expected to do in very adverse scenarios. So we gave a sneak peek of this in our white paper. So we show an example where demand for Terra or transaction volume goes down by a very significant percent, more than 90%. And we show how the system responds by changing transaction fees, as well as by changing the Luna burn rates to achieve a very smooth reward profile over time. So we did a lot of work to make sure that this mechanism performs correctly and in a robust way, even when subjected to a significant amount of stress. And we gave a sneak peek of how we've approached this and how we've modeled the problem in our white paper. So we show an example where demand for Terra drops by a very significant amount, more than 90%. And we show how the dilution that is caused as a result of that for Luna holders is compensated by both increasing transaction fees and by increasing the rate at which Luna is burned whenever Seanage is created. And the quite beautiful output of this process is looking at rewards that accrue per unit of Luna. So the reason why this idea of a unit reward is so important is because it captures how much you're rewarded post-dilution rate. You look at, for every unit of Luna, regardless of what supply is, how much you're rewarded over time. Right? And by making sure that that unit reward, if you bought Luna today and you just hold it for a decade, right, you don't want to care if the supply of Luna goes up by 10x or if it goes down by 90%. Right? If the supply of Luna goes down by 90%, then your share of the pie has 10x, right?
Makes sense. Makes a lot of sense. I mean, this seems like a really good trade-off for the Luna holder, right? But at the same time, this doesn't seem very good for the Terra SDR user, right? So now this Terra SDR user has a jiggling rate of transaction fees. Sometimes it's going to be 0.1, sometimes it's going to be 0.5%, sometimes it's going to be 0.7%. So there was almost like this design decision you had to make, that you had to either put volatility for the Terra SDR user in the form of variable transaction fee levels, versus you could have said that the Luna holder that's running a validator will not have a stable reward rate. Why did you put volatility to the user rather than to the Terra holder? Because the way I think of it, the Luna holder is naturally a speculator, right? Like they've, out of all of the assets they could have owned in the world, they have not chosen treasury securities, they have not chosen government bonds, they have not chosen index funds, they have gone and bought Luna, right? Now, if they've bought Luna, this is usually somebody that has volatility tolerance, right? Otherwise, they wouldn't be buying it.
Let me stop you right there. I see the point you're trying to make. We have very much designed Luna to not appeal to speculators. So I would beg to differ in, for example, US Treasuries necessarily being the safest investment. The US is notoriously bad with handling debt. So yes, in that sense, you could say that Luna is this unknown asset and someone who buys it is risk tolerant. But both the design as well as the philosophy here is to be the exact opposite, right? So we want participators in the network to commit for the long haul, and if they make a bet on Terra being viable currency that has a future, then we want to make sure that that bet, in some sense, is not influenced by short-term uncertainty, right? And so basically, I think the question you raise is very apt, which is it's a very interesting system design question. How do you allocate risk in a system where you're trying to produce a stable output, right? So you can think about an unstable input, which is demand for Terra, right? So that could go up, that could go down, and you have an output that you want to keep stable, which is the price of Terra, right? And the question is, okay, you're designing this black box, and you need some way to absorb that uncertainty, right? So a nice analog that you can think about here is how insurance works, right? So I want to insure my car, or I want to insure my home, right? And there's uncertainty into what will happen. There's risk in my home burning or my car crashing. And I don't want to stomach that uncertainty. But I am happy with paying a stable premium. And I want to build a system where that uncertainty is stomached by someone else, right? And that's where the idea of insurance was born, right? So insurance companies are paid stable premiums. In exchange for that, they will stomach the uncertainty of what happens if 1 million houses burn tomorrow, right? So I think from a system design standpoint, that applies very much to our question over here. And as you said, there's a trade-off that you need to make, right? So how do you allocate that uncertainty amongst different parts of the system? So our rationale here was, as I said, Luna is very key, both to security in terms of proof of stake and also towards stability. So we wanted to make sure that Luna holders are properly compensated for long-term commitment, right? On the other hand, of course, Terra is the linchpin of the network, right? So the entire success of the ecosystem and of the economy depends on Terra being a useful currency. And so the way we thought about this is, look, so we want to be successful players in e-commerce. What do our competitors charge? So if you look at Visa, if you look at MasterCard, PayPal, etc., transaction fees are egregiously high. Timon, our first e-commerce partner alone, pays almost $100 million in fees to credit card networks, right? Which is absurd. It's actually a fairly large part of their earnings, right? So we designed this mechanism with that in mind to make sure that we are significantly cheaper in terms of transaction fees compared to our competitors. So if you look at the 2 to 2.5% that an e-commerce company has to pay to, say, Visa, we offer, I would say on average, fees that will be probably significantly less than 0.5%, right? And in the absolute worst case, they will be at 1%. So thinking about this from the perspective of risk allocation, what we said is, look, if fees that Terra pays are capped at 1%, which is already much better than what you would pay to Visa, and on average are much less than that, then that is an uncertainty we are willing to tolerate, right? Anything above that is where we draw a line and we say, look, then past that point, Luna validators will actually have to stomach that risk. So for example, if you think about transaction fees transaction fees will max out at 1% because that is the worst we're willing to accept when it comes to Terra. And after that, if there is still volatility and if dilution continues, then that will be stomached by Luna holders. So it's essentially where you draw the line, right? You have to allocate risk. And we made the conscious decision of saying we want Terra to be highly competitive and much cheaper to transact with than credit card networks. At the same time, we want to be able to compensate Luna holders and protect them from volatility. How do we split that risk? And we drew that 1% line to essentially make that trade-off and split uncertainty between the two. To finish this point, you raised a good point, which is, well, sure, you might be cheaper than Visa or MasterCard, but still those fees are uncertain, and it wouldn't be ideal for me as a Terra user to face uncertain fees, right? So there's a couple of points here. The first is that we actually, at the protocol level, make sure that fees do not change too fast. So there's a cap that does not allow fees to increase, I believe, in our current implementation by more than 0.1% over a given month, which is 5% of what you would currently pay to, say, Visa. So essentially the change in fees is very slow, and we want to make sure that it is predictable what added burden users would pay. And then on top of that, there are solutions that you can adopt at the e-commerce level. So for example, our e-commerce partners will almost surely be offering stable fees to users for a very long amount of time. And that uncertainty is something that they will typically be able to handle in exchange for all the benefits that they get from the network. So bottom line, what that would mean is that as a Terra user, chances are the fees you'll be paying will be highly stable and might not change for a year or 2 years, or potentially ever. And that uncertainty in fees would potentially be stomached by the e-commerce company that, again, is making a bet in Terra in terms of Terra being competitive relative to Visa, etc., when it comes to fees, and also it being a superior payment method if you look at benefits that we can offer, such as discounts, if that makes sense. So long story short, there are many ways to protect end users from this uncertainty.
That's very interesting. So like the way I'm imagining it is like, you have this tower of uncertainty. So at the bottom is the Terra holder that's like holding SDR. This is the party that should have the least uncertainty. Their thing should always be equal to 1 SDR. They are at the bottom. This is the thing you're trying to protect. The next sort of level feels to me is the Luna holder, right? The Luna holder that's running a validator is the next level. So you will sacrifice their stability in order to maintain the stability of the lower level, but you would also want to have their reward rate to be predictable. So that's the second level. The third level, which is even more uncertain, is these e-commerce companies, right? Or maybe the third level is actually the Terra user that is paying using Terra SDR to an e-commerce platform. So they have a higher chance of being exposed to uncertainty, and the nature of their uncertainty could be that today they were paying like 0.5% transaction fees, and sometime it jumped to 0.7% or something like that. So that's the third. And the highest level of uncertainty is for the company, the e-commerce company, because in the end, the e-commerce company is the one that is actually paying the transaction fees, and they are exposed to the highest uncertainty. But their trade-off is that their transaction fee level is between 0.1% and 1%, which is lower than the credit card, Visa, MasterCard levels. So they have an advantage there.
Absolutely, yeah. So it comes down to how you design the system to optimally balance this risk. And essentially, there's no way to eliminate risk completely, right? Like if we take the insurance example, there is no magical way of saving houses from being burnt or somehow making that risk or that damage disappear, right? But rather, we've come up with an elaborate system which allows each player to take the risk they're willing to take and then essentially distribute risk in the most optimal way. So there's an uncertainty or there's a payout that the insured person is willing to take by paying a stable premium, and that uncertainty is transferred to the insurance company. And for us, we have a much more complicated system, and we had to figure out what is the optimal way of balancing that uncertainty to make sure that things work in harmony together, with, of course, the foundation of everything being Terra being a stable currency. And we put a lot of thought into this, and I think it's a design that could come close to what is ideal. I think there's a lot for us to learn. So chances are there's a lot that we can refine in this design, and I'm sure there's tons of improvements that can be made after we collect some real-world data, see how users, see how merchants interact with the platform. We've gotten very positive engagement and a lot of excitement from our validators. So that's very exciting. We've been getting great feedback. So I'm absolutely sure that this design will improve a lot based on the things that we've learned.
I feel like there's still so many interesting topics to go into here, right? Like, so the topic of, we have seigniorage and like, how do you allocate seigniorage across these different usage, like either burning Luna or incentivizing adoption of the protocol? That's an interesting question. I think there's an interesting design questions around how do you make these transaction fee level choices, and how does this stability, like what kind of model does the transaction fee choices and ensure stability? So there are like many topics that we couldn't get into today. If the listeners enjoyed this podcast, do drop us a note, do drop like Nick a note, so that we are, incentivized to make the next installment of this series that covers questions like these ones.
Absolutely. So I'll add to that we will shortly be releasing a stability stress test, which basically demonstrates in a more formal way than what we did in our white paper, the conditions under which we see the Terra peg remaining stable based on this mechanism. And I think it answers some of the questions that you touched upon. It adds a lot of color to some of the things that we discussed in a more quantitative way. And it helped us also understand what conditions are the ones in which the peg survives well, and what are the conditions under which the risk is higher. We were quite positively surprised by the results. So we'll be sharing this quite soon and would love to collect feedback from the community.
Cool. So we look forward to having you back on the Chorus podcast, Nick.
Excellent.
As our listeners know, we are one of the validators in Terra. And until now, our experience of Terra has been really smooth, right? So as a validator, we are often in like the boiler room, right? We interact with all of these networks and we can actually see what network has better code, right? Like, so you have networks in which we miss a ton of blocks and we know that there's something rotten about the code. But like with Terra, our experience has been really smooth as a validator. So I really look forward to what comes next from the network.
I'm very glad to hear that. And we're very grateful for your support and for being part of the network. And hopefully you'll be able to participate in the long-term upside.
Definitely. So that was this episode of the Chorus podcast. Do send us some feedback on our Telegram channel or on YouTube. If you have guest ideas, we'd be happy to listen to them. And we look forward to seeing you the next time.
Thank you for listening to the Chorus One podcast. Visit chorus.one for more information about our work. Don't forget to subscribe to the podcast to stay tuned on new episodes airing every Monday.